Greetings traders and welcome back to another In-Depth with Chris episode. In today's discussion, we'll be talking about the smooth moving average. This is in fact a technical analysis based indicator, so those of you that are my TA based traders, well, you've got a treat in store for you today. This is something that we hope will help you get closer to your goal of passing the Gauntlet Mini, or at the very least, help you progress farther in your trading career. Now, without further ado, let's go ahead and work our way through those disclaimers. That way we can get on to the juicy information that follows. And while we're doing that, if you haven't already, please click that like and subscribe button down below so I can keep coming out with content for all of you out there. Now let's get going. As part of being a proactive trader, it's important for us to constantly be aware of the various tools that are at our disposal should we so choose. That way we know how to handle any situation that comes our way, at least in theory. And as we scour the internet looking for new tools or things that we haven't yet covered or used, one thing we might come across is the smooth moving average. So we'll start off with what the smooth moving average is at first. And I bet you can't say that one 5 times fast. At least I can't. The smooth moving average is quite simply a moving average that assigns weight to price data points over a long period. And the point here is that traders are going to use this to gauge market trends according to a series of averages over a given period. As the data becomes more available, they'll recalculate the averages to accommodate the newer periods. And this is why we call it a moving average, because it is constantly accommodating newer periods. We can think of the SMMA, which is the smooth moving average, as a hybrid of its better known siblings, the simple moving average and the exponential moving average, otherwise known as the SMA and the EMA. The SMA looks at the price of a traded asset and it divides it by the given period to be studied, but it looks at all periods equally. Now, unlike the EMA, the EMA is going to place more emphasis on recent data, as we've discussed in the past. The smooth moving average provides a broader view of things than both of these by smoothing out, so to speak, the short-term market fluctuations. This added accuracy helps traders confirm market trends quicker and hopefully more reliably. This chart that we're looking at shows Microsoft, and we have on it both an SMMA, which is the green line, we have an EMA, which is the red line, and we have an SMA, our simple moving average, which is the blue line. And we can see how over the course of the same period of measurement, how these lines did not follow the same exact trajectory, even though it was relatively similar. Here we have the calculation for how the smooth moving average comes to be. Now, this isn't something that you'll need to memorize, as most platforms are already doing this math for you as it plots the indicator in front of your very eyes. But just for the sake of completeness, I wanted to make sure we included this problem so you are aware of exactly how it is if you're interested. But for the rest of us, let's keep moving. The smooth moving average is an indicator that plays a vital role in many trading strategies. It is in fact a lagging indicator, which means it's great for confirming prevailing trends. This leads us into 3 of the most common trading strategy categories that smooth moving averages seem to fall into. The first is the trend following category. This is when the trader buys an asset whose price is already on the rise and confirmed to be trending upwards in the trend because of the smooth moving average. They can also short the asset when the price is already falling and confirm to the downside with the smooth moving average. The beauty with this strategy lies in its relative simplicity. It's not only common sense to buy an asset that is rising and common sense to sell an asset that is falling. The smooth moving average line itself can serve as a guide on when to buy. We can look at the steepness of the line and how long that line has actually been in play for as our justification for getting in when we are using it as a trend following type of strategy with the smooth moving average. Then Then we have the reversal side, and the reversal is a little bit trickier and generally not for the faint of heart. It can provide massive opportunity when it's done correctly, but it is much harder in most people's eyes to do correctly. The way reversals with smooth moving averages are found is generally with a moving average cross. So instead of using just one line, traders will look to use a couple of lines across different periods and pay attention to when the short line moves underneath the lower line and look at this as an opportunity to potentially sell as the short-term momentum is falling below the previous existing longer-term momentum, or the other way around, when the shorter moving average looks to move above the longer term line, they can look at this as an opportunity to buy. Then we have the current price concept that goes in conjunction with using SMMAs. And this is really something that can help us if we're just starting our trading day and looking for some great entry points and we're trying to make a more informed choice. If the asset's current price is trending above the SMMA line, that can be a signal to buy. And when it goes down below the SMMA line, then we can look to exit the position. The reverse is the case when we're looking to short. We would sell when the current price goes below the SMA line. And we would look to exit that position then when price therefore rises back above the SMMA line. Relatively simple concept to make sure we're on the right side of things with the help of the SMMA. It's important to understand how the smoothed moving average, the SMMA, compares to the simple moving average, so we don't ever really confuse the two or use them exactly as we would use the others. The most significant difference between the smooth moving average and the SMA is that the time frame involved with calculating the SMA is usually quite a lot shorter. An SMA uses the shorter period to calculate the average, and one of the drawbacks with this is that the short-term trend line does create for a possibility of false signals. If we use a longer-term trend line, that can provide a stronger signal, but in return, we usually now have a lag. Traders also have to wait until the price action is confirmed before making their moves in the market, and in doing so, they might miss out on some prime trading opportunities when the trend began. The smooth moving average helps avoid this issue by covering an extended period of time, thereby removing that short-term fluctuation bias, and because it's smoothed out, traders can easily view the trend with a little bit more confidence. Then we have the smooth moving average when it's compared to the exponential moving average, which we refer to as the EMA. The EMA is an advanced form of an SMA, and it can help traders confirm the prevailing market trend a little bit faster because of that added weighting factor on more recent prices. However, the sensitivity to recent volatility can also be the main drawback to an EMA. For example, if the market experiences a sudden spike, the EMA line will reflect that change. Suppose the trader is not using another indicator to confirm the trend and the strength behind it. In that case, they could take action based on the false signal generated by the short-term volatility and get themselves involved in a mess. The smooth moving average, however, helps prevent this because it is also considering past data generating that average, and instead of emphasizing on more recent data, it enables a more accurate and relevant average that is not easily swayed by short-term volatility. In conclusion, the smooth moving average is an indicator that can provide some very valuable insight into what's going on in the market, as well as provide opportunities to entry using a variety of strategies like we discussed. As far as what the smooth moving average is not so good at, it does provide a rather myopic view of the information that's on your screen. It provides a smoothed average over what's going on, but it's not providing ulterior views, which is why the smooth moving average is often used in conjunction with things like the Bollinger Bands, the stochastic oscillator, as well as a variety of other technical indicators to further confirm what's going on in the market in a more fine point manner. But until next time, thank you for joining me as always, folks. Please make sure you click that like and subscribe button down below so I can keep coming out with content for you all out there. And until then, good luck in the markets out there. Stay safe. I'll see you soon.